really appreciate you taking time to attend this event. I hope you are having a fantastic show. A lot of things have changed in the past 2 years. Equity markets are different. Commodity prices are different. I myself have gained 15 pounds. And I just realized that this morning when I tried to get into the suit, which is why I don't really want to stand there and just talk to you, make it more personal. But let's do a quick survey just to see what you guys are doing. How many of you are actively investing in gold stocks these days? That's about 30%. How about EV, electric vehicle metals? Again, 30%. How about base metals? So copper, zinc, nickel to an extent. So that's 20%. So 30% gold, 30% EV, and 20%. So base metals have a weak outlook, it seems like, in this room. So what I'm going to do today is talk to you about some of the sectors that we like and some of the sectors that you might want to avoid this year. My name is Sid Rajeev. I'm the head of research at Fundamental Research. We are one of the largest independent research shops in North America. We cover different sectors. We cover different companies. Sectors include resource, oil and gas, technology, real estate, Bitcoin. So people looking for independent research, they come to us, both institutions and retail. And at the end of the presentation, I'll tell you where to find our reports. In terms of performance, we've been highly ranked by third-party agencies who rank analyst performance. Just to give you an example, since we initiated coverage on our top picks, they have performed. They're up 47% as of yesterday versus the TSX Venture, which was down 21%. And whenever I make these kind of statements, this slide has to follow. So that's for the regulators and the stock market cops. Let's look at the winners and losers of last year. Obviously, electric vehicle metals, EV metals, and uranium outperformed the mainstream metals. Mainstream metals, I mean copper, zinc, and gold and silver. So EV metals by far was the number one, were the winners. Lithium was the lithium beat other metals by a huge margin. And the primary reason for that was the significant demand in EVs last year. EV sales doubled to more than 6.5 million vehicles last year, and is expected to be 30 million vehicles by the end of this decade. In terms of uranium, why did it perform? This chart explains why. It's supply disruption. Russia accounts for 6% of primary uranium production, 35% of enriched uranium. Russia and its neighbor, even though Kazakhstan is not an ally, they account for more than 45% of primary uranium production. That makes uranium supply chain highly vulnerable. So we feel that potential supply disruptions in the future are likely. And on the other side, demand we are expected to increase steadily because uranium remains, or nuclear remains, one of the cheapest and cleanest sources of energy. So on the demand side and the supply side, things are looking positive for uranium prices. We feel that uranium prices in the long term have to be at least $65 a pound versus the current $50 a pound to make it attractive for developers to give them enough incentive to advance these projects. So that's about uranium. Let's take a quick look at base metals. Now, it's very easy to analyze base metals demand side because the demand is directly proportional to the global GDP growth. And as you can see here, global GDP growth is expected to significantly decline this year. Not just, and that's to across all of the main regions, GDP is expected to slow down this year. And that's because many reasons. Few of them include rising rates, supply disruptions, inflation, the slowdown in China, and of course the war in Russia. So these things combined are going to result in a significant decline in GDP growth, and that's going to affect demand for base metals. Now when you look at the supply side, this is a quick summary of what we're going to expect for copper, zinc, and nickel. Both copper and nickel are expected to see a supply surplus this year, which means both commodities could be under pressure in terms of prices. Zinc is expected to see a surplus or deficit this year, followed by surplus next year. So I think this year zinc should perform better than copper and nickel this year, and then zinc could weaken later this year or earlier in the next year as a surplus is expected. Moving on to EV metals. To appreciate the demand for EV metals and to forecast the demand for the EV metals, it's very important to know the different types of battery out there. Currently, NMC, which is a nickel, manganese, cobalt, and LFP, lithium iron phosphate. These are the two most commonly used batteries. LFPs are used in China, NMC is the rest of the world. But in terms of when you compare the technology or the efficiency of these two, we feel that NMCs is going to dominate the market mainly because it has higher energy density, meaning they are smaller, they are lighter than LFPs, and for vehicles, weight and size is very important. So we think NMC is going to dominate EV space later. So let's look at the composition of an NMC. So it has three main components. The positive side, or the cathode, which is filled by nickel or cobalt. The negative side, or the anode, is filled by graphite. And the electrolyte, which is the medium connecting positive and negative, is lithium. Lithium and graphite is used in almost all battery types. The question is, will cathode, which is nickel and cobalt, can it be replaced or not? We feel it's not because of the dominance of NMC, which needs to have nickel and cobalt. This is one of my all-time favorites tables ever, I would say, because it quickly summarizes the whole dynamics in the EV space. It shows the amount of metal required in an EV, starting with cobalt, about 10 kilograms of cobalt in an EV, lithium is 20, nickel is 30 kilograms, and copper is 80 kilograms, graphite is 50. Now, we know the EV sales forecast, which is about 30 million vehicles by the end of this decade. Multiply that number with these amounts, you can actually project what the supply is going to be or demand is going to be for each metal by the end of this decade. We did that, and then we saw that cobalt, lithium, and graphite, the demand of these metals are going to double over the next decade. Nickel and copper already being big markets. We're seeing an increase, but not as much, 60% and 30% respectively. So this table shows us that it's very easy to know that long-term outlook for all these metals are extremely positive, mainly because of the increase in demand from EVs. The near-term problem is that almost all of these markets is expected to be in a supply surplus this year, except lithium and graphite. So even though the lithium and graphite are expected to be in a small deficit, but we don't think it could potentially result in higher prices this year. So we are expecting a correction across the board for EV metals this year, especially because of the supply surplus and the fact that prices went up a lot last year. Moving on to the next slide, gold and silver, which is our hot commodities for this year. And I have many reasons to say why I'm bullish on gold and silver, but these are the 5 top reasons, starting with negative real rates, inflation, rising production costs, inverse relationship with equity markets, and of course geopolitical tensions. Number 1 is negative real rates. So gold is a capital preservation asset, at least that's what investors perceive it as to be. So when real rates are negative, demand for gold has historically gone up. We are at minus 6% real rates right now, and we think real rates will be negative through the year, especially because inflation is going to be high throughout the year at about 6 to 7%. That's our estimate, and we don't believe the interest rates will reach as high. So negative rates is going to push demand for gold higher. The next point is obviously inflation. Inflation, gold, and U.S. money supply has historically been correlated. This is a beautiful chart which shows that M2 money supply and gold prices have been positively correlated. And M2 money supply since the pandemic is up 43%. Historically, they only grow at 6% per annum. So that increase in money supply and the fact that oil prices are at record highs, this has to be baked into inflation, which is why we believe inflation will be persistent throughout the year. The third point is rising production costs. Since the beginning of the pandemic, production cost is up 25%. When production costs are higher, simply economics, commodity prices have to be higher for producers to incentivize producers and developers. The fourth point is historically, there's been negative correlation between gold and equity markets. We've already seen a 15% correction in the S&P 500 this year, and we feel there is room for more correction in the S&P 500 or the equity market this year, primarily because the price to earnings of the sector is right now at 20 times versus the historic average of 16. So we could see another 10 to 15% or even 20% decline in the equity markets, which should support gold demand and gold prices, we think. And finally, the fifth point I mentioned is geopolitical tensions. Again, historically, political tensions high, demand for gold is higher, and we think there is a chance or increasing probability of an extended Cold War between the West and East, and that's going to keep demand for gold high, at least for this year. So those were the 5 reasons why we like gold and silver. But how do we put a price to it? How do we forecast gold? At Fundamental, we use a number of models, several models, to forecast gold and silver prices. This is one of the models we use. We use regression analysis between gold. A lot of key factors. Find the relationship and find an equation, and then use that equation to potentially project gold prices. We use variables like inflation, interest rates, oil prices, and money supply. But there's a huge problem with this model, which is it cannot be explained to anyone. I don't usually get to explain or walk people through this rationale of what I did here. So today what I'm going to do is walk you through 2 simple models, which I hope I'm able to explain it to you and give you what my forecast for gold is. Number 1 is I connected US money supply and gold prices. Now, gold is pretty much unperishable. It's very difficult to destroy gold. So you can actually find the value of all the mined gold above the ground. And there is a relationship between value of gold mined and US money supply. Historically, that's been 64%, meaning gold value is 64% of the money supply. Right now, this percentage is 55%, which means value of gold is undervalued versus money supply. And if we assume that this number moves to 64%, gold should be trading at $2140 an ounce. The second model is also connected to the money supply. We looked at 20 years prior to the pandemic. From 2000 to 2019, money supply increased by 6% per annum. Gold increased at 9% per annum, so 8.4% per annum. That's about 1.4 times increase in money supply. Inflation grew at 2.1% same time. And let's look at what happened since the pandemic. Money supply is up 42%, which means gold prices should have gone up by over 60% just based on the historic relationship. And that gives us a number of $2,480 an ounce. If we just based on historic relationship and what has happened since the pandemic. So these things have to be reflected in gold. So just based on these 2 models, we think gold has to trade somewhere between $2,100 and $2,500 an ounce anytime this next 12 months. So that brings us to the most exciting part of this presentation, which is our top picks. I'm going to give you 5 names quickly from each sector, starting with gold and silver. The first 3 are producers: GCM Mining, Golden Minerals, and Step Gold. GCM Mining is the largest primary gold producer in Colombia. It's one of the very few juniors that give dividends. It's trading at under 2 times EBITDA. Sector average is 4.5 times, so significantly undervalued. It's a profitable mine. The second one is Golden Minerals. They have a producing mine in Mexico, profitable. They have a huge catalyst coming up because they are advancing their second mine, which is going to be a larger mine, to production next year. The third one is Step Gold. They are one of the gold producers in Mongolia. The stock got beat up last year because they had to suspend production for a bit, for almost a year because of supply chain disruptions. But they just restarted production, and the stock has not reflected that. So we feel the shares are undervalued purely based on fundamentals. The last 2 are Cornerstone Capital and Lumina Gold. These 2 hold massive copper gold projects in Ecuador. Ecuador is kind of underfollowed by the mining community. Even though BHP, Newcrest, Anglo American are active there, we feel these 2 are ideal or very attractive acquisition candidates. Lumina Gold is backed by Ross Beatty. Cornerstone has a huge partner called Soul Gold who is funding all the developments. So across all the multiples, these two look like attractive acquisition candidates and undervalued. Moving on to EV metals. I have 5 companies here, 2 in lithium, 1 nickel, 1 graphite, and 1 cobalt. Lithium names are Noram Lithium. They are a project in Nevada, close to Albemarle, which operates one of the only lithium mine in the U.S. Noram is in a location where there are many juniors there, and we feel there is consolidation that's going to happen in that region. Lithium Chile is a recent company which is kind of acquired a project that is quickly turning out to be that there's potential to be a producer in Argentina. They came out with a resource estimate with attractive parameters that could potentially mine lithium economically. FPS Nickel holds one of the largest nickel deposits in the world, advanced stage. Again, multiples wise, it's undervalued when you look at comparables. South Star Battery is a graphite project in Brazil, and with the low capex, they can be advanced to production very quickly. And Fortune Minerals is the largest primary cobalt deposit in North America, plus the benefit of having a lot of gold in its resource, more than 1 million ounces of gold in its deposit. Finally, we move to base metals. I have potash. Fertilizer demand has gone up significantly, mainly because supply disruptions in Russia. And VRIC Agritech is our top pick in the space. This stock is up 300% since we initiated coverage back in December, January. They are the largest, or they want to be the largest potash producer in Brazil. Brazil imports more than 95% of its potash consumption. Metals Uranium, again, it's associated with Robert Friedland. They have a lot of projects in Africa, advanced stage projects in Africa. Panoro Minerals, huge advanced stage copper gold projects in Peru. Hot Chili, again, same story. Large projects in Chile, and World Copper, they have projects in Chile and Arizona. So these are all advanced stage projects. They have a resource estimate. They've done economic assessment. So why I'm coming out and giving you these names is they've already demonstrated or confirmed their economics. And when we look at the comparables, they look multiples across pretty much all the multiples we use for valuation. So that's from me today. We have a booth outside just across. So if you have any questions, please feel free to come by. And our research reports can be found at researchfrc.com. We also have a YouTube channel, Fundamental Research Corp. So please sign up and check us out. And if you like it, let's make it a long-term partnership. Thank you and have a good day.